People talk about the US dollar like it's a natural law, as if it rises and falls because of the economy, or because of confidence, or because markets feel a certain way. But the dollar is not a law of nature. The dollar is a price. And like every price, it is a battlefield of expectations. Here's the uncomfortable truth. The Federal Reserve doesn't just move interest rates. The Fed moves the psychology of the world's reserve currency. One sentence from the Fed can do what 1,000 economic reports cannot. It can shift what investors believe the future will look like. And when beliefs shift, money moves. That's why the dollar can surge even when the headlines look bad, and weaken even when the data looks good. Because the dollar is not only about what is happening, it's about what people expect to happen next, and what they fear. So today we answer one question the right way. How does the Fed influence the dollar, really? Not the textbook version, the real version. The channels, the reflexivity, the feedback loops, and the scenarios that decide whether the dollar becomes a wrecking ball or a refuge. Stay until the end, because I'll give you a framework I call the dollar dashboard. 5 signals you can track to understand the Fed's dollar impact without predicting every meeting. Let's begin. Welcome back to the podcast. Today's episode is the Fed's influence on the dollar. Quick disclaimer, this is educational content, not financial advice. The dollar is influenced by many forces: fiscal policy, growth, geopolitics, risk appetite, global liquidity, not only the Fed. But the Fed is the most powerful short to medium-term conductor of dollar conditions because it shapes rates, liquidity, and expectations. Now, if you've ever asked, why did the dollar rise when the Fed cut rates? Why did the dollar fall even though the Fed sounded hawkish? Why does everything in the world seem to break when the dollar spikes? Then this episode is for you. Because the dollar is not just a currency, it's the global price of funding. And the Fed influences that funding environment more than any other institution on earth. Here's the idea. The dollar is a reflexive asset, meaning the dollar doesn't just reflect reality, it changes reality. When the dollar strengthens, it tightens global financial conditions. Dollar debt becomes harder to service. Commodities priced in dollars can feel more expensive. Emerging markets can come under pressure. Global trade and liquidity can slow. Then that tightening feeds back into markets, which can create more demand for dollars as a safe haven, which strengthens the dollar further. That's a feedback loop. And once you understand that loop, you stop asking, is the Fed good for the dollar? And you start asking the professional question, which regime are we in and which feedback loop is dominant? Here's our roadmap for this series. Part 1. Foundations. Today, what the dollar really is, why the Fed matters more than headlines. The core framework for thinking clearly. Part 2, the 3 main channels, the real mechanics. Rate differentials, the obvious one. Expectations and forward guidance, the powerful one. Liquidity conditions, the underestimated one. Part 3, reflexivity, why the dollar becomes a wrecking ball. Strong dollar equals global tightening. The short dollar trade, why crises often look like dollar shortages. Part 4, scenarios, what happens to the dollar under 5 regimes. Hawkish hold, soft landing, cuts, recession, cuts, inflation, resurgence, crisis, liquidity response. Part 5. The dollar dashboard. Practical takeaways. The 5 signals to track how to think like a macro investor. The final rule. Don't predict, prepare, and I'll keep it narrative and practical, not academic. Here's the question I'll answer later. Does the Fed move the dollar, or does the dollar force the Fed? Because sometimes the dollar becomes so strong or so weak that it changes financial conditions enough to influence what the Fed can do next. That's reflexivity again. And once you see it, you'll never watch a Fed meeting the same way. All right, in part 2, we build the core mechanics, the 3 channels through which the Fed influences the dollar, and why the second channel, expectations, often matters more than the actual rate move. Let's go. If you want to understand the Fed's influence on the dollar, forget the drama of press conferences for a moment. Think like a macro investor. The Fed influences the dollar through 3 channels. Rate differentials, the obvious one. Expectations, the powerful one. Liquidity, the underestimated one. Most people only watch channel 1. Professionals watch number 2 and 3 because they change the game before the Fed acts. Let's break each one down in a way you can actually use. This is the textbook story. If U.S. interest rates rise relative to other countries, the dollar tends to strengthen. Why? Because money goes where it's paid. Higher yields attract capital. Foreigners buy U.S. bonds, global investors hold more dollars, carry trades favor the dollar. So far, simple. But here's the mistake beginners make. They treat rates as a single number. In reality, the dollar responds to a curve, not just the Fed funds rate. What matters most, front-end rates, 1 to 2 years, because they reflect Fed policy expectations. Real yields, because inflation-adjusted returns drive long-term capital relative rates versus Europe, Japan, emerging markets. The professional shortcut. When the U.S. offers more attractive risk-adjusted yield than alternatives, the dollar has support. But this is only the beginning, because rate differentials can be overwhelmed by the other channels, especially expectations. This is where the dollar becomes reflexive. The dollar doesn't wait for the Fed to move. The dollar moves when the market believes the Fed will move. So the most important Fed tool is not the hike or cut. It's the shaping of expectations. Higher for longer, data dependent, we are close to restrictive enough, we will act as appropriate. These phrases are not poetry. They are weapons. They change. What markets price for future policy, what investors expect for growth and inflation, and how risky it feels to hold dollars. Why expectations move the dollar more than the actual rate move? Because markets are forward-looking. By the time the Fed actually cuts or hikes, the dollar may have already moved weeks or months earlier. So you get the classic confusion. The Fed cut rates and the dollar went up. Why? Because the market expected more cuts than the Fed delivered, or because the cut triggered risk-off demand for dollars, or the Fed sounded hawkish and the dollar fell. Why? Because the market believed the Fed couldn't sustain hawkishness, or because inflation growth expectations shifted in a way that weakened real yields. The Soros lens. Narratives are traded. When the narrative changes, capital repositions. That repositioning is the actual Fed move. Imagine markets expect 4 cuts this year. Then the Fed signals, we're not there yet. Even without changing today's policy rate, the market reprices. Fewer cuts, higher expected short-term yields, tighter financial conditions. That repricing strengthens the dollar. Nothing happened, but everything changed. That's why professionals watch pricing, futures, curves, expectations, more than headlines. This is the channel most people ignore until it breaks something. The dollar is not only a currency, it's the world's funding lubricant. When the Fed tightens liquidity, directly or indirectly, global financial conditions tighten. And when global conditions tighten, demand for dollars often rises. How the Fed affects liquidity. QT, balance sheet runoff, can drain reserves and tighten conditions. QE, asset purchases, can loosen conditions and compress spreads. Standing facilities and emergency tools can relieve dollar shortages during stress. Regulatory and plumbing effects can change how easily dollars move through the system. Here's the key intuition. Tighter liquidity often supports the dollar, but it can also create instability that forces policy reversals. This is where reflexivity shows up again. A stronger dollar tightens conditions. Tighter conditions create stress. Stress can force the Fed to change tone. That tone change can reverse the dollar. So liquidity is not a one-way story. It's a feedback system. When the dollar rises sharply, it often feels like the world is short dollars. Why? Because global debt and trade are often dollar-linked. Many institutions hedge and borrow in dollars. When risk rises, people rush toward the currency that settles global obligations. So dollar strength can become self-reinforcing in stress. Risk off, demand for dollars, dollar up, conditions tighten, more risk off. That's the wrecking ball dynamic. And yes, sometimes the Fed becomes constrained by it, which is why the open loop matters. Does the Fed move the dollar, or does the dollar move the Fed? We'll answer it fully in part 3. Here's the clean framework you should keep. Think of the dollar as a triangle with 3 sides. Rates, relative yield advantage. Expectations, what the market believes the Fed will do next. Liquidity, how tight or loose the funding environment feels. The dollar strengthens most cleanly when U.S. rates are attractive, the Fed is expected to stay tight, and liquidity is tightening. The dollar weakens most cleanly when rate differentials shrink, the market expects easier policy, and liquidity is expanding. But real life is messier. Sometimes rates say up and liquidity says down. Sometimes expectations flip overnight. So your job is not to predict perfectly. Your job is to identify which side of the triangle is dominating right now. In part 3, we go deeper into the reflexive loop, why the dollar behaves like a stress indicator, why short dollar positions can unwind violently, how a rising dollar tightens global conditions and feeds back into policy. And we'll return to the question, does the dollar sometimes force the Fed's hand? Because that's where macro becomes real. Now we enter the real world. Textbooks say the Fed moves the dollar through rates and policy, but markets are reflexive. Sometimes the dollar becomes so strong or so weak that it changes financial conditions enough to influence what the Fed can do next. That's the uncomfortable loop. The Fed influences the dollar influences the world influences the Fed. If you understand that loop, you stop being surprised by markets. So in part 3, we answer 3 questions. Why does a strong dollar tighten global financial conditions? Why do crises often look like dollar shortages? When does the dollar start influencing the Fed? Let's go. Here's the core truth. The dollar is the world's default funding language. It settles trade, prices commodities, backs debt, and anchors portfolios. So when the dollar strengthens, it's not just FX. It changes the cost of doing business globally. A stronger dollar can mean higher effective debt burden for borrowers with dollar-linked liabilities, more expensive imports for countries and companies paying in dollars, pressure on commodity consumers, and a tightening of global liquidity. Think of the dollar like gravity. When it pulls upward, everything feels heavier. Let's build the loop step by step. Step 1. The Fed tightens or is expected to stay tight. Markets price higher real yields or higher for longer. Step 2. The dollar strengthens because yield advantage plus safety demand positioning. Step 3. Global financial conditions tighten, borrowing becomes harder, risk premiums rise, EM assets wobble, liquidity thins. Step 4. Risk-off demand increases. Investors seek safety, reduce leverage, cover risk. Step 5. Demand for dollars rises even more because obligations are dollar-linked and because dollars are the settlement asset. Step 6. Dollar strengthens further and the loop intensifies. That's the wrecking ball phase. This is why strong dollar episodes can feel like a global stress event, even if US data looks fine. The key phrase you should remember. Host, dollar strength is a form of tightening, sometimes independent of what the Fed intended. And when tightening becomes too severe, it can constrain policy. Which leads us to the short dollar problem. In calm periods, many global players behave as if the dollar will be stable or weak. They borrow in dollars, hedge loosely, hold risk assets funded cheaply, search for yield abroad. That behavior is effectively short dollar, meaning they benefit when the dollar is weak or stable, and they suffer when the dollar rises sharply. When the dollar spikes, the unwind is violent because they need dollars to repay or hedge. They sell other assets to get dollars. Selling other assets increases risk-off, which increases dollar demand again. This is why crises often appear as falling risk assets, widening spreads, and a rising dollar simultaneously. It's not always because the US is strong. It's because the world is deleveraging into the settlement currency. This is crucial. In stress, what people want most is not yield. It's liquidity. And the most trusted liquidity is dollars. So a crisis can create functional dollar shortage dynamics. Demand for dollars surges, funding markets tighten, institutions scramble for cash, cross-border dollar funding becomes expensive. This is why, historically, central banks and the Fed have had to think about dollar liquidity beyond US borders, because global dollar stress can boomerang back into US financial conditions. You don't need to know every plumbing detail. You need to know the macro reality. The dollar is the global margin call currency. When stress hits, the world raises dollars. Now we answer the open loop. Does the dollar ever force the Fed's hand? Yes, indirectly. Not because the Fed targets FX directly, but because a dollar spike can tighten financial conditions fast. Lower risk asset prices, higher credit spreads, pressure on global growth, stress in funding markets. That stress can feed back into US conditions. Tighter credit, slower demand, weaker growth outlook, rising systemic risk. At that point, the Fed may respond by changing guidance, by slowing tightening, by providing liquidity tools, or by signaling flexibility. So the Fed moves the dollar, and sometimes the dollar moves the Fed through the channel of financial conditions. This is reflexivity. A price changes reality. Reality changes policy. Policy changes the price again. If you're watching the dollar, don't ask, is the Fed hawkish or dovish? Ask, what is the market pricing for rates and cuts? Are financial conditions tightening or loosening? Is risk appetite rising or falling? Is there evidence of a funding squeeze? Is positioning crowded? Because the dollar moves when those forces shift, not when headlines shout. In Part 4, we make it concrete with scenarios. 5 Fed regimes and their typical dollar impact. Hawkish hold, soft landing cuts, recession cuts, inflation, resurgence, crisis, liquidity response. And I'll show you how the dollar behaves in each regime and what to watch so you're not guessing. Now we do what professionals do. We stop trying to be prophets. We build a scenario playbook. Because the Fed doesn't operate in a vacuum. The dollar doesn't move for one reason. It moves as the market shifts between regimes. So I'm going to give you 5 Fed regimes and how the dollar typically behaves in each, not as a certainty but as a map. And as you listen, remember the triangle from Part 2. Rates, differentials, expectations, forward guidance, liquidity, financial conditions. Each regime changes the triangle differently. Let's go. Rates stay high. The Fed communicates patience. Inflation risks still matter. Financial conditions remain tight. Typical dollar behavior. The dollar often stays supported, especially if other central banks are easing faster. Carry remains attractive. Global funding stays tight. But here's the nuance. In this regime, the risk is that a strong dollar tightens the world too much and creates stress. So the dollar can behave like a slow grind higher until something breaks. What to watch? Front-end yields, 1 to 2 year, staying elevated, widening credit spreads, sign of tightening. Risk assets struggling, emerging market pressure. Key idea, hawkish hold equals structural support for USD, but rising risk of wrecking ball dynamics. Cuts begin, but carefully. Inflation is contained. Growth is slowing, but not collapsing. Risk appetite stays alive. Typical dollar behavior. This can produce a weaker dollar, but not always. Why? Because if the whole world is also easing, the differential may not change much. So the dollar's direction depends on whether US cuts are faster than others and whether risk appetite stays strong. In a true soft landing, investors rotate toward risk and the dollar can drift lower as global capital flows outward. What to watch? Declining US front-end yields, rising equities, tighter credit spreads, improving global PMIs, EM strength. Key idea. Soft landing cuts, dollar can weaken as fear premium fades, unless differentials stay wide. Cuts accelerate. The Fed shifts from managing inflation to stabilizing growth. Markets become risk-off. Volatility rises. Typical dollar behavior. This is where people get confused. You're cutting rates. Shouldn't the dollar fall? Not necessarily. In recession cuts, 2 forces fight. Lower yields, weaker dollar. Risk-off demand plus dollar shortage dynamics, stronger dollar. Often, in the early phase of stress, the dollar strengthens because it's the settlement and funding currency. Then later, if the Fed is aggressively easing and liquidity expands, USD may weaken. So the recession cut regime often looks like USD up first, stress phase, USD down later, liquidity phase. What to watch? Volatility indexes rising, credit spreads, widening funding stress signals, Fed messaging shifting towards support. Key idea. Recession cuts equals dollar can strengthen despite cuts because fear dominates differentials. Inflation reaccelerates. The market reprices higher terminal rates. Fed turns more hawkish again. Real yields rise. Typical dollar behavior. This often drives a stronger dollar, sometimes sharply. Because real yields matter, markets reprice. Higher for longer, global risk appetite can suffer. This regime can be brutal for global assets because higher US real yields attract capital. The dollar strengthens, global financial conditions tighten. What to watch? Inflation surprises, real yields up, commodity behavior, Fed tone turning restrictive again. Key idea. Inflation resurgence, equal USD often becomes a wrecking ball again. A financial stress event threatens stability. The Fed prioritizes liquidity. Facilities expand, messaging calms markets. Liquidity becomes the dominant channel. Typical dollar behavior. This regime can produce a turning point. Initially, during the crisis, USD often spikes, flight to safety. Then, once liquidity tools stabilize markets, the dollar can peak and soften, especially if global risk appetite returns and liquidity is abundant. What to watch? Emergency liquidity language stabilization in credit funding markets. Volatility falling risk assets recovering MAR. Key idea. Crisis response. Dollar can reverse once liquidity overwhelms fear. Here's the pro move. Don't guess the regime. Watch what the market is pricing. Ask, are expected cuts rising or falling? Are real yields rising or falling? Are credit spreads widening or tightening? Is volatility rising or falling? Is risk appetite improving or collapsing? Those 5 questions tell you which regime is taking control. Because the dollar is a reflection of those conditions and a driver of them. In Part 5 final, we'll build the tool I promised, the dollar dashboard. 5 signals you can track weekly to understand the Fed's dollar impact without obsessing over every headline. Then we'll summarize the whole episode into one page and close with a final rule. Don't predict the Fed, track the regime. Now we finish with what you can actually use, because the goal of macro is not to sound smart. The goal is to stay positioned correctly as regimes change. The Fed's influence on the dollar is powerful, but it's not magic. It flows through rates, expectations, liquidity, and then reflexivity does the rest. So I promised you a tool, the dollar dashboard. 5 signals. Simple, trackable, practical. Then I'll give you a one-page summary and a closing rule you can remember. Let's go. You don't need to watch every speech. You need to watch what markets are pricing and how conditions are behaving. Here are the 5 signals. 1. The front-end rate path. Market pricing of Fed policy. What it tells you, how the market expects the Fed to behave over the next 6 to 24 months. Why it matters. Because the dollar moves on expectations, not just today's rate. Interpretation. Pricing shifts toward higher for longer. USD support. Pricing shifts toward faster cuts. USD pressure, unless risk-off dominates. 2. Real yields, especially U.S. real yields. What it tells you, the inflation-adjusted return of holding dollars. Why it matters. Real yield is the gravity for long-term capital. Interpretation. Real yields rising supports USD. Real yields falling can weaken USD unless fear is dominant. 3. The risk regime. Risk on versus risk off. What it tells you, whether the world is seeking growth or seeking safety. Why it matters. In stress, the dollar can rise even when yields fall because the dollar is the settlement currency. Interpretation. Risk off. Volatility up. USD often strengthens risk on, volatility down. USD can soften as capital flows outward. 4. Credit spreads, financial conditions. What it tells you, how tight or loose the funding environment is. Why it matters. Financial conditions are the transmission mechanism between the Fed, the dollar, and the real economy. Interpretation. Spreads widening, conditions tightening, supports USD, often, but raises break risk. Spreads tightening, conditions easing, can weaken USD as fear fades. 5. Dollar positioning crowdedness, the pain trade indicator. What it tells you, whether the market is already leaning heavily long or short dollars. Why it matters. Crowded positions reverse violently. Interpretation. USD crowded long, vulnerability to a dovish surprise. USD crowded short, vulnerability to stress spikes and short squeezes. The dashboard rule. Simple. Post. When 3+ of the 5 signals point in the same direction, the dollar trend tends to be cleaner. When the signals conflict, the dollar is usually choppy and headline driven. Professionals reduce leverage when signals conflict. That is risk management. The Fed's influence on the dollar. 1 page. The 3 channels. Rates, rate differentials in the yield curve. Expectations, forward guidance changes pricing before the Fed acts. Liquidity, QTQE, facilities change global financial conditions. The reflexive loop, Fed policy shifts, USD moves, global conditions tighten loosen, risk appetite shifts, USD demand changes, Fed constrained, empowered. The wrecking ball dynamic, strong USD, global tightening, stress, more USD demand, stronger USD. 5 Fed regimes, hawkish hold, USD supported, stress risk rises. Soft landing cuts, USD can drift weaker if risk on holds. Recession cuts, USD up first, stress, then down later, liquidity. Inflation resurgence, USD strengthens, tightening accelerates. Crisis liquidity response, USD spikes, then can soften as pipes open. The final principle, don't predict one meeting, track the regime. Here's the sentence I want you to keep. The Fed moves the dollar, but the dollar moves the world, and sometimes the world moves the Fed. That's reflexivity. So if you want to think like a macro investor, stop asking, what will the Fed do? Start asking, what is the market pricing and what regime are we in? Because markets don't reward certainty, they reward preparedness. If this episode helped you, here's what to do. Once a week, review the dollar dashboard. Policy path, real yields, risk regime, financial conditions, positioning. 5 signals, 10 minutes. That's how you stop being surprised.